Welcome you all in my another series. In this series, basically, we are going to focus on fixed income securities. So it means bonds. For example, let's say types of bonds, pricings, valuation of fixed income securities, usage of fixed income securities, and so on and so forth. Because in this particular series, our main focus would be on to decode the critical terms of bonds which can help for investing as well as how to deal with day-to-day operations in a banking life. So basically throughout this series we want to support to the two types of audiences, one which is let's say for looking for an investing or maybe advising, guiding, research part, and second one is investment bankers who want to work as investment bankers and take care of fixed income securities operations. All right. So to understand all of that, it is important, you should go through the entire series, because this would be my first session, but you can stay tuned and again connected with the channel for a next videos as well. So to start with this particular session, I would suggest you to please pay attention because it's a highly critical topic. Highly critical, it means highly critical. Let me tell you something. 80% financial professionals, they don't understand the relationship between interest rates and bond prices. But I'll decode that in just 10 to 15 minutes. I want your full attention on this particular topic. So let's discuss now. So the topic name is the interest price relationship with bond price and why it is so the inverse. All right, so let's discuss that now. See, if you see the topic which is the relationship between bond prices and interest rate is inverse. What do you mean by inverse, guys? Can you guess? I would request you should guess now for a moment. You should just try to guess why it is so inverse and what is meant by inverse exactly, right? So meaning that when interest rates rise, bond price falls, and when bond interest rates fall, bond prices rise. And here is why this happened. Basically this the increase and decrease process, you can call it as a inverse. Inverse, it means in short, bond price when goes up, your interest will goes down, right? And when price goes down, then your interest will goes up. So basically this relationship, you can call it as an inverse relationship. But the most important question is why this happened. Can you guess? Let's understand this now. So let's take an example, because I don't want to just walk you through the theoretical description like this happened and that happened. I would like to narrate this story in a very practical way. So let's try to understand this now. Let's take an example. Okay, let's say case number 1, we have two cases, case number 1 and case number 2. See, again, let me just remind you, do not miss or do not skip any point, because everything will be very, very crucial till the last moment of my session. All right, let's take an example now. Case number 1, TCS bond. Let's say TCS has issued bonds in 2023 with coupon rate, because every bonds carry coupon rate. Coupon rate, it means it's nothing but it's like a, the interest payment, where when you invest in bonds, so investor receive fixed income amount of return on bond investment. So that fixed income portion will call it as a coupon. So it means here, let's say TCS announced, let's say already, because this happened in 2023, coupon rate 10% for per annum, right? TCS announced 10% for per annum as a coupon rate. Let's say a investor invested invested amount of rupees 100k US 100k rupees, it is in rupees, okay. So 100k rupees at face value, at face value. So it means issue price and face value, it was same at the time of issuance. That's the assumption. Now, if I talk about per annum income, if I talk about per annum income with this bond scheme, let's calculate it. 100k into 10% divided by 100, this income it will receive for 12 months. So TCS will pay this amount of interest payment to the investor. Why? Because when investor invest money in TCS bonds, basically investor send cash payment to the company for investment, right? And on cash payment, basically TCS process this interest payment, which is an income part. So that income portion you can also call it as a interest payment as well, interest or coupon, right? Depends. But in a fixed income securities, basically will explicitly call it as a bond coupon, right? Coupon. So it's a coupon basically, and that coupon that we can redeem at the time of maturity. And once you redeem that coupon, you will receive as an investor will receive 10k rupees. So it means 10,000 rupees. All right. 10,000 rupees to the, okay, this was 1 lakh, it was 1000k, and this one is like, the 100k. Sorry, my bad, 10k and 100k. What I'm doing, forget that. So 10k will receive as an income. All right. See, so far here is, you don't need to even think of, where do we see the inverse relationship between bond price and interest price, right? You don't need to worry about at all at the moment. But now, when I look at the second case, right? Second case, which we have a recent case, guys. Let's say Wipro issued bonds in the year of 2025 at coupon rate. Here the coupon rate is 12% for per annum. And let's say B investor now invested again 100k, similar amount, issue price and face value both are same, invested 100k in Wipro bonds. Now let's calculate income or coupon amount. Coupon amount, let's calculate it. Now if I calculate the coupon, again total principal amount, this would be principal or the issued amount into 12% divided by 100, just divide with 100, total income would be 12k or 12,000, which will Wipro pay to you, or Wipro will pay to the investor at the end of the year, or every year I would say. All right. Now just think for a while, A investor and B investor both have invested same amount, which is a principal, in the bond, but A investor is earning 10,000 for per annum and B investor is earning 12,000 for per annum. Now you tell me, as an investor, as a cognizant investor, in which investment scheme you will invest? In which investment scheme will or you will invest? My question is to you. I'll give it to you 10 seconds. I'll take a pause. You can answer, means you can try to answer in comment section. I'll give it to you 10 seconds. I'll wait. Let's see. Come on. Try to answer in comment section. Come on, guys. Come on. Okay. I got a couple of I got couple of feedbacks. All right. So now 80% people, they said this scheme or number 2, like Wipro company investment would be beneficial because it is offering 12K or 12,000 rupees as an investment or coupon value. So would prefer to invest in Wipro. All right. This would be your investment option, correct? Now, as a investor, let's say you are an investor and you have a two option. Option number 1, to invest in TCS bond which was issued in 2023. This scheme is still live, so it means investor can invest, right? TCS bonds at 10% coupon rate, and you have a latest investment scheme which is offering 12% coupon rate. 12% coupon rate. Which one you will select? If you ask my answer, then definitely I'll select this one, because here I'm earning almost 2,000 rupees extra. Now you tell me, don't you look for an extra income? I'm sure you will look for it. Now let's come to the inverse relationship. What do you mean by inverse relationship? Inverse, it means now, see, most of the investor, see, the mindset would be when you have two options in a fixed income securities, most of the investors, again, it's a trend, most of the investors, they'll try to look for a switch. They'll try to look for a switch like जैसे मान के चलिए TCS ज़्यादा सैलरी नहीं दे रहा है, विप्रो दे रहा है for a same role, तो ज़्यादा एम्प्लॉइज विप्रो में जाएंगे ना. So kind of that. So you have now, means most of the investors now they'll try to look for a switch from TCS investment scheme to Wipro. TCS investment schemes to Wipro. And when they switch, so ultimately demand for this particular bond will increase, right? Demand for this bond particularly, it will increase. But when we talk about demand for this particular bond, demand will drop. Demand will drop. And here you can apply basic economic rule. So how that basic economic rule works? Let's say TCS bond. What will happen with TCS bond? Low demand just because of fixed income, or market investor will feel that 10% is lower interest rate when they compare with current interest rate. That's the difference, guys. Now your question would be like, sir, who decide this interest rate? See, this interest rate which is something RBI revise it, right? In India RBI, or in US Fed government revise it, and when they revised it, new interest rate, it will apply to the financial instruments, or institutions will follow the new interest rate basically. But bonds issued at fixed interest rate, and when they issued at fixed interest rate, so definitely you will see same sort of situation. Low demand and high supply, right? High supply, which will impact on price. Low price. So it means ultimately, now understand this, increase in interest payment. This will lead to the low demand of the TCS bond, not the Wipro bond. Understand this, guys. Wipro bond, and there would be high supply because most of the investors, they'll try to look for a sell it out so that they can purchase the stake in Wipro. All right, and that's when high supply will pump up in the market and price of the bond will down. Price of a bond will goes down in the market. The reason is again demand and supply. Low demand, high supply, price impact. And in case of, if I talk about Wipro, for a Wipro definitely you can see strong demand because the Wipro is offering higher interest rate, right? So for Wipro, you can see like, high demand as compared to TCS, and limited supply, in the market. You can see again high price for that matter, and even the say at the same interest rate, or the current market interest rate, whatever interest rate would be, current market interest rate, at that price you can say the Wipro will receive high amount of demand, because the investors, they'll try to switch from TCS to Wipro investment scheme. So this is how you can link with, when we say inverse relation which talks about which talks about interest and price of a bonds, but that in a relationship with the existing bond scheme and new bond scheme. See, for a new bond scheme, that won't affect on the price, but for existing bond scheme, that definitely affects on the price. And here you can see that TCS bonds will impact, or their price will impact in the market. So this is how basically inverse relationship works, guys, and vice versa. Same example you can apply it in other way around. What if, let's say, if I talk about let's say TCS bonds coupon rate, it's 12%, right, which is issued in 2023. Wipro bonds coupon rates, which is 10% in 2025. Now, if I ask you this question, which option as an investor, which option you will prefer to invest? Of course, you will invest, you look for a TCS, right? Even if it is an existing or old one, still you will look for a TCS bond price, or not the Wipro one. Why? Because here with the new investment scheme, you can see loss of 2%. So it means when the interest rate decrease, so basically you can see more and more investors will prefer the existing investment scheme. But for a new investment scheme, definitely you can see like interest rate which is decreases, right? Here the interest rate which is decreases, but you can see the impact on price of existing bonds, right? Existing bond price, it will increase. So it means when you compare, because this would be the market interest rate, guys, as per the second example, when the interest rate, let's say, decreases, the existing bond price basically it will go up. Why? Because more and more investors, they'll prefer to invest in TCS bonds in second example. So this is how you can understand this, the inverse relationship of interest rates with bonds price basically. So there are lots of terms, I would say this was just one. So if you have understood, then I would say rate 5, because that help us to understand your expectation. And if you haven't understood, then you can rate 2, so that help us to again understand your expectation. Then maybe we can change in the flow of teaching, or maybe we can change in the way of explanation, so that followers will receive the insightful information. And apart from this, if you guys are really looking for understanding of such a terms, then we have launched course on investment banking, which covers everything investment banking. That programs equip with all the the necessary things, including valuations, bond modules, trade processing, and all. And apart from this, we also offer job guarantee as well. Job guarantee with 100% placement fees refund if you don't get a job. Placement fees refund. So if you are really interested for all of this, then connect with us at this number, or else check the link in the description and click on the link to see the course details and everything. All right. So yes, thank you for watching this. We'll see you in next episode on a fixed income securities, and we'll cover the settlement life cycle of fixed income securities. Thank you.